Hello guys, welcome to this lesson on fair valuation. So I dropped a video on the course section on fair valuation, but that was on balanced price range. That video was just an explanation on what balanced price ranges are. That was a presentation on that one, but today's lesson is going to actually delve into what fair valuation is. And then we're obviously going to go into the different types of fair valuation price. So we're talking about fair value gaps, imbalances, inefficiencies, voids, all those different things. But before we go into all those terms, we need to define what fair valuation is. Now, going back into one of the earlier lessons I did on the course, where I talked about the relationship between the central banks and the funds or large speculators, and how price is engineered behind the scenes. I talked about how when orders are picked up, the algo will then start to deliver price towards a level where there can be counterparty distribution or counterparty liquidity. Now, in the process of the algo delivering price to these levels where there can be counterparty liquidity, you tend to get oftentimes inefficiencies in price. So you tend to get the market. Also, by the way, if you hear me sneeze or cough, for some reason I just developed cold, and that's what's going on today. So I do apologize about the sneezing or me drawing my nose on the call. I'm sorry. I think I might just do this one video today, so it's not going to be, because this is a course, and there's going to be tons of people in the future who want to watch the course, and imagine going through 2, 3, 4 videos and I'm doing this. It's not going to be good for them. So alright, so let us discuss what fair valuation is in price. Fair valuation simply is an area fair value for liquidating or accumulating new positions by the market makers. Okay, so that essentially means, and this is something I've told people which baffles them about inefficiencies. Inefficiencies are a form of liquidity. Okay, now inefficiencies are different from classic liquidity. Inefficiencies are interbank liquidity. Okay, a bearish fair value gap is a buy side liquidity pool. A bullish fair value gap is a sell side liquidity pool. But the thing is, to interbank traders, these are areas of fair value where they will either offset pre-existing position or reaccumulate new positions of pre-existing order flow. Now, why are these areas of fair value in price? Because in the process of previous delivering price was delivered inefficiently. Okay, market was not delivered efficiently towards that general liquidity. So when price returns back down into the range, the algo will remember that and will provide an opportunity for interbank traders to repopulate that old area of inefficiency with new transactions, and that's what we call fair value. Because to the interbank traders, that is an area of fair valuation, right, where they value the asset on a fair basis, because at that area there was a lack of valuation at that price, because the algo was artificially pumping the market or dropping the market towards a level of counterparty liquidity. So that's where the term fair valuation comes from, because to the interbank traders, this is an area of fair value to them. So they will go into the marketplace and they will go and take actions or take transactions around these areas of fair valuation. Now we have the different types of fair valuation in price. The more popular ones, which everyone knows obviously, is the fair value gap. Okay, so fair value gap. What is fair value gap? Fair value gap simply is a portion of price that is delivered on a one-sided basis. So we could have a bullish fair value gap where the market only delivers price on the buy side, or we can have a bearish fair value gap where the market only delivers price on the sell side. Now we can identify that visually by the presence of just one candle. So I'll show you an example. This is a fair value gap, okay, because we left this range there was no delivery down into this, and the market expands higher. So what I'm going to do here is I will actually show you guys visually what I mean by fair value gap before I go into the actual candlesticks and we talk on fair value gaps. Okay, so I'm gonna squint this chart and take it all the way to the upside. And now what I'm going to do here is when we've identified the general liquidity price. So let's call this buy side liquidity pool. Or old high, okay, which is the general liquidity that the market should be rushing up into. Now, in the delivery price up into that general liquidity, which is a liquidity pool or old high, what we want to see is the market deliver efficiently. So what do I mean by the market delivering efficiently? We want to see the population of both buy delivery and sell side delivery. Okay, so when I say buy side delivery, when this candle starts the bullishness, the next candle opens at the close of the previous candle, and oftentimes what you get in that candle is you start to see a decline. Okay, that decline lower, okay, is the delivery of sell side inside that range of buy side. So the previous candle, which is delivered only on the buy side, from the open to the close of the candle, that is the buy side delivery. Now, if this candle had a wick, okay, so let's assume there's a wick in this candle. Okay, now our buy side delivery starts from the open of the candle to the high of the candle. Why? Because when we open up, the run lower was sell side delivery. That could be run down into a order block or a discount array that allowed for institutional accumulation. But once you start delivering to the upside, that is all buy side delivery. So from the open to the wick of the candle, that's all buy side delivery. Now what we want to see for efficient dealing in price is we want to see the market open up on the next candle, and we want to see the market start to decline. It does not need to completely decline all the way down into the open of the candle where the buy side delivery starts. We just want to see the market try to decline just a little bit into the range, and then it can start its expansion to the upside. Okay, and then what you get is the wick of the candle. And now on the second candle, we have buy side delivery, sell side delivery into the previous range of buy side, and then buy side expansion. Then the market can expand all the way up and probably start to close lower. And they have the wick of the candle. And now you have again buy side delivery from the high of this candle to the high of this candle. That's our last year of buy side. Why? Because as we traded up and we started to trade lower, that initial decline, okay, was distribution in that candle. Remember the daily range I defined. Alright, you have below the opening of the daily candle, you have accumulation, then you have the profit release phase, and then you have the distribution. That distribution there, that same concept is what's applying to this candle. Right? Same concept also applies here. So we have sell side here, we have sell side on the wicks. So we have sell side here, we also have sell side here. So from the wick of the candle all the way to the high of that candle, we only have one-sided delivery. Now when the next candle passes through this candle, then it becomes efficiently delivered. So next candle opens up, trades very close into the previous range, and then starts to expand again up into that general liquidity. And we have something like this. That initial run lower, that is sell side delivery, and then this candle closes like this. Now this is, even though these are very close together, until we get up into that liquidity, this is still relatively efficiently delivered for our purposes. Okay. Now, if we did not trade in close proximity to the last area of sell side delivery, which is this candlestick's wick, and it was something like this, okay, then we have a lack of sell side delivery inside this portion of price. That lack of sell side delivery is what we class as a bullish fair value gap. And what would happen there is if the market does not run up into that liquidity, if it returns down from this open, if it returns and slams down there, interbank traders will go into the marketplace and populate that area with accumulation or buy orders. Okay, so the algo will draw the market lower to allow interbank traders to populate that area with buy orders, and then the candle trade on there, and you start to see trade higher, away from there, away from there, away from there, away from there, and you get something like this. And this will be the effect with the wick of the candle. Alright, and so now you have a bearish candle. Oh no. So we have a bearish candle into our fair value gap, and this fair value gap is a bullish fair value gap. Why is this a bullish fair value gap? Because this was a fair value gap created on a bullish delivery of order flow. If we have a fair value gap created on the bearish delivery of order flow, that is a bearish fair value gap. Fair value gap created on the bullish delivery of order flow, that is a bullish fair value gap. So the purpose of this fair value gap is simply for interbank traders to repopulate an area that they deem fair valuation, because there was a lack of sell side delivery inside there. So as the algo trades back down there to allow for efficient delivery price, interbank traders will go in there and populate with long orders. And then what you get next is you get the candle open. Sometimes it could trade down there again, and then it starts to rally away from there. And you have something like this. When the market trades on there again, interbank traders are going into the marketplace and they're reaccumulating more, even more there. Then you get expansion into the liquidity. Okay, and get something like this. So in the process of a run higher from a discount inside our previous range into a premium where we have a buy side liquidity pool where there can be counterparty transactions, what would happen there is in the process of delivery by the algo, you're going to get some porous price action. Okay, so those porous price action are what we class as inefficiencies. Now in this example, we class this as a bullish fair value gap, or we can term them a BISI. Okay, so a BISI simply stands for buy side imbalance, sell side inefficiency. So that essentially means that we have an imbalance on the buy side and we have an inefficient delivery on the sell side because there's a lack of sell side delivery. So it is inefficient on the sell side, but it is imbalanced on the buy side because we have only one-sided delivery price, which is the buy side. So that's an imbalance. So the process of the market trading down there to offer interbank traders for a long position, that's where the market becomes balanced, and this is what we call redelivery. Okay, so the process of the market trading back down into an area of imbalance is what we term redelivery. So this is going to be called redelivery inside a candle. So we are being redelivered into a bullish fair value gap, and then we see the expansion higher into the buy side liquidity pool. Alright, so let me get rid of the drawings and we can go and look at actual candlesticks for today's presentation. Now, the same concept also applies to bearish fair value gaps. All you just simply do is you just invert the concept I just discussed in this session on the sell side, and that gives you a bearish fair value gap. So this is a 4 hour time frame of, this is a daily time frame actually. So we're going to go down into a 4 hour time frame of USD JPY, and you can see first let me go out to a daily time frame. Alright, so I think that was the highest side we made on USD JPY. That was last year. Okay, so that was how I saw in this JPY from last year. That's awesome. Funny because I never knew Let us see range extensions, high to low. So we're going to use a 1.5 extension level. Alright, so that is a 1.5 extension level of this range. So I'm using an extension level of this range with the Fibonacci. So these are the times where I'll use Fibonacci in price. I don't use Fibonacci for entry. Okay, I only use Fibonacci if I'm trying to measure the equilibrium of an order block, or the mean threshold of order block, or the consequent encroachment of an inefficiency. That's when I'll use Fibonacci, or target extensions. Okay, other than that, I don't use Fibonacci for identifying premium versus discount, because I can easily eyeball the level and I know what I'm looking for. Okay. Alright, so on the 4-hour time frame, we expanded up into 1.5 extension level of that Fibonacci from the weekly chart, and you can see we have a range of what I call a liquidity base, just like I taught you on the initial lesson. So when we have an expansion out of a liquidity base, you have a return back down into an order block, which I defined, which is what you have here, and then another series of expansion starts again. This is a propulsion block. You have a fair value. Remember the importance of fair value. That's for retracements. Now look at this. In the process of the run up into that extension level, that's at 1.3921. The market does so inefficiently. From this model of range, where we have the order block, we see the market start the actual inefficiency. So let me show you what it looks like here. So you can see we have sell side being delivered, and then we start the buy side delivery, and then from the low of this candle to the high of this candle, we have only buy side. The moment this candle trades down into the order block and starts to expand again, now our buy side inefficiency, or our buy side imbalance, starts from the high of this candle to the low of this candle. So that is where we have a range in price, where we are sell side inefficient and we're buy side imbalanced. So we want to see the market return back down into that as fair valuation. Okay, and what you see there is, as the market trades on there, we have a little bit of a pop higher. Now this one not seem significant to you, but that is a significant range, because that is a 144 pip range. So market trades on there, and market traders will come into the marketplace and they will repopulate with pre-existing order flow. Okay, remember that either repopulate with pre-existing order flow, or they're repopulated with new order flow or new delivery. Now, as the market trades on there, that is an error of fair valuation to interbank traders, okay, the interbank markets, because this is a sell-side liquidity pool. Okay, it is a form of a sell-side liquidity pool, but to retail, they don't understand that this is a form of sell-side liquidity pool. But to interbank traders, they understand that this is a form of sell-side liquidity pool where they can go in and be counterparty, just like an old low or a short-term high, where interbank traders will go in and they'll short a run or a false break above a short-term high to become a party against them. That is also the same concept here, because that is an error of fair valuation to them. Then you have the market expand higher, and they have a smaller range here. Now, what type of range is that? That is a balanced price range. Okay. Again, so inside our fair value gap, bullish fair value gap, we have a balanced price range. So I'm gonna extend this out. I'll make this a little bit thinner than the original fair value gap. Okay, so that is this. So our balanced price range starts from low of this candle, top of this candle, and that is a balanced price range. And you can see the market trades on there and re-offers a chance for higher expansion. So we actually went down to a 1 hour time frame. You can see there that balanced price range. Market shares down there. Interbank traders will go into marketplace, add orders. Market shares back down into a new BPR, balanced price range. They'll go in and repopulate. So look at this. They trade down there again, and you see displacement, and then displacement. Where are they displacing to? They're displacing to a level of premium. Okay, the market will displace into a level of premium where they can be counterparty liquidity. Now the question is, what is the level of premium we have on our chart that we can take note of? If we go to our time frame, we have a bearish order block here. That was an area of institutional distribution. Okay, so remember the definition of order block when I did the lesson order block, right? Price will return back up into an order block to allow for redistribution, to a bearish order block to allow for redistribution. So interbank traders will go along here, they can be counterparty to the redistribution, institutional redistribution, by pairing their accumulation against distribution up here. So you see the relationship in the marketplace. Okay, so the market gets up there, they are being counterparty to willing sellers up there, and then the market displaces lower, not because of the transaction, but as a result of the algo driving price from the new position or from the new order flow into a level of existing liquidity, which is the low of this overall price range. Why? Because there's going to be a lot of individuals who are going long inside the entire range. Let's look at what happens next. As soon as the market trades lower through the balanced price range and the fair value gap, we have a return back up into that balanced price range, and the market sells off. So this is an inversion level, which I taught on the Telegram, where you just invert the BPR on the sell side once you identify the new order flow, and the market will remember that, and interbank traders will go into the marketplace, and the same actions they did here, they will go in there and they will repopulate with new shorts, and you can see the displacement there. And where is the market displacing to? To an area where they can exit as counterparty, which is discount. Alright, so the question is, where is our area of discount in price? Look at all of this run higher, the entire run higher. Okay, where did the run higher start from? Start from all of these down candles. So 1, 2, 3, 4 collectively makes up a bullish order block. So the market is returning back down into the discount of this overall price range. Okay, from this fractal in price, market is returning back down to the discount. So let's identify the bullish order block. That's a bullish order block. Starts from the candle. Okay, so 1, 2, 3, 4 down candles makes up our bullish order block. So what the market is doing there is, once the market gets down there, look at all of this run higher. Okay, because interbank traders will then, from their short positions, they can distribute against longs or willing buyers in price, and then the algo starts to drive the market back up into an area of fair valuation. Where's that area of fair valuation? That is that old fair value gap. Look at the sensitivity there and sensitivity there. Okay, that's an area of fair valuation. But guess what? If you took out the entire range from low to high there, it is coming in at a premium. This is at a premium. It's not a discount. Okay, so when we're at discount, the market is retracing. Where's it retracing back up into? It's retracing back up into premium. Remember the lesson, I think it was lesson 5 I did on premium versus discount, where I talked about why the market respects levels like this. You can see the same fractal in price. Okay, so we are trading inside the premium of this overall price fractal. At the same time, we had displacement from this high all the way down to the low. So if you took out your range and measured premium versus discount, you can see we are also at premium. So I have a confluence of premiums in alignment with an area of fair valuation, which is a bearish fair value gap. Now, when the market trades below and then comes back up into that, this is what we term as a reclaimed fair value gap. Okay, you could call it an inversion level, but the word here is a reclaimed fair value gap. Now, what type of fair value gap is this? This is a bullish fair value gap. So we have a reclaimed, I'm going to use a plus sign here. We have a reclaimed bullish fair value gap. Okay, so when the market gets up there, that should be a recognizable level for interbank traders, because that was an old level of inefficient delivering price. So they will go in there and they will redistribute, or they will reaccumulate new order flow, or sorry, they'll reaccumulate pre-existing order flow to then get in flow with market delivery, where they can be counterparty liquidity against pending sell side liquidity here. Why? Because there's going to be a lot of individuals who are wanting to short the breakout. Okay, so if they want to short the breakout, think, if they're trying to short a breakout, so when I say they, I mean retail. Retail is trying to short a breakout. Okay, who's going to be counterparty to them? It's going to be interbank traders. Okay, institutions and bank traders who are short inside the range, they're offering your liquidity to willing sellers at the breakout of this range here. That's what's going on. So that is the relationship price, and this is why fair valuation is important price. So on the next lesson, I'll go more into volume balances and liquidity voids. I think those are the other two that are missing. So we've discussed balance price ranges. So I think what's left is volume balances and liquidity voids, and I think that's it. And redelivery balance. So I think the lesson on redelivery balance, I will drop that as part of the course, so you can watch that. I've done the previous presentation on redelivery balance, so you can go and rewatch the presentation on that one, and hopefully that's insightful also, just like this lesson. So what I'm going to do is I'm going to rearrange the video on the course, and I'll make this lesson of fair valuation 6A, and then balance price range is going to be 6B, and then redelivery balance is going to be 6C. And then the lesson I'm going to do on liquidity voids and inefficiency will be 6D. And I don't want to do another video, so I'm not like coughing or something on that video. So let's see. If I feel better, I'll do another one today. Otherwise, I'll wait until probably tomorrow, where I feel way better, and then I'll do another recording. So you guys will have an awesome weekend, and trade safe.